Good afternoon and welcome everyone to the meeting of the CERS Investment Committee. We have a relatively straightforward agenda this afternoon, and so we can proceed accordingly. With some of the legal services, basically prepare the opening statement, if you would, please.
Sure. This is a regularly called meeting of the County Employees Retirement System Board of Trustee Investment Committee. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute Section 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public via Facebook. If you are speaking and are not appearing by video, please identify yourself before talking. In the event the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned to another date.
It looks like Dr. Hackbart has frozen. He indicated he was having some internet issues. Mr. O'Meara, are you vice chair?
No,
That I don't know.
that would be Mr. Cheatham. Lau, would you consider getting us in, and we can circle back to the approval of the minutes until hopefully Dr. Hackbart will be able to rejoin us.
Is it just Bill and I?
Yes.
So that's not a quorum. Correct?
Everything's informational though, so other than the approval of the minutes, you don't need a quorum. You can continue with the meeting with less than a quorum for informational only.
Okay. Vicki, you want to go ahead and do roll call at this point and note that Dr. Hackbert's having internet issues and may be back on shortly.
Yeah, Sherry will do that.
Sure, I can do that. Dr. Hackbart, who we know is having internet issues. Mr. Cheatham.
Here.
Dr. Milkman. Mr. O'Meara.
Here.
And Mr. Powell. Thank you. And there is no public comment, Mr. Cheatham.
Okay, with that, we'll proceed on into the portion of the agenda, I think straight to item 6. Wilshire, I think, provided a pretty in-depth set of information in the packet. David, would you like to walk us through that as we wait on Dr. Hackbert?
Sure. We're going to have Craig walk through some capital market review information as a start.
Okay.
Thank you. I'll start on page 8 and give some brief comments on these slides again that are prepared to cover the period of the second quarter of this year. So obviously several months has nearly passed since then, but I think these themes remain the same. Starting here on page 8, you see the change in non-farm payrolls in the top in blue, which is illustrating how we've had a very long, steady run of increasing payrolls going back several years now. Not only have they been increasing, they've been exceeding expectations, which is shown there in the bottom. Those bars represent the change versus the surveyed median. So strong growth and also outperforming expectations to the upside. But as we move on to the next page, we see that there's potential signs that the labor market is cooling off a bit. And since it has been such a key driving force of keeping economic growth positive as the Fed has aggressively raised rates, these early signs are worth paying some attention to. So first here we see a plateau in the number of hours worked. You see the downward trend line out, which is illustrated by that arrow there. The blue line is average weekly hours. So when employers want to scale back, one of the easiest marginal ways to do that is to cut hours where they have hourly workers. They might be concerned that if the labor market continues to be strong and they need to hire back later, that cutting positions and rehiring is an extensive and difficult, expensive process. So easiest marginal changes for them to cut hours, which it appears we're starting to see that downward trend in hours. On the next page, we see also an increase in initial jobless claims. So despite the last few readings being actually headed the other way, the overall trend in the last year-to-date period at least seems to be higher. So this is another sign of weakening in the labor market. And again, that is important because the labor market's been the most resilient part of the economy as the Fed has continually raised rates. People are waiting for the shoe to drop, and we haven't seen it yet in the labor market. Typically, the Fed's trying to balance employment and inflation, and they've raised rates to fight inflation, and employment's not taking the hit when usually those two things are expected to move in opposite directions. So as we move to page 11, some other signs of potential weakness. Survey data, which is moving from hard data points to more soft data. These surveys give us more of a forward-looking expectation, and you can see here in blue that manufacturing PMI has already slipped below 50, which is the delineation between expansion and contraction, while services has held up a bit more, but is right down in the vicinity of moving into negative below 50 territory as well. The Conference Board on the bottom of the page also has a leading economic indicator index, and you can see that has fallen pretty steadily here from 2022 into 2023. On the next page, 12, we see what some consider to be one of the strongest indicators of a recession on the horizon, and that's an inversion of the yield curve. So here we have the 10 versus 3-month and 10-year versus 2-year Treasury spreads, and both of those have now moved into steeply negative territory. The highlighted regions are obviously the current region at the current time period in the far right, but then the other times we've seen these indicators move below zero. We had the early 2000s dot-com bubble bursting. We had the same signal right before the global financial crisis. And then we actually had late 2019 inversion, at least with the 3-month, the 2-year really skirted that line. Not that the market was predicting COVID, but it was predicting an economic slowdown, which COVID obviously exacerbated. So this is one of the clearest signs the market can send that it's pricing in a slowdown. Now it might be a relatively short and shallow one, but the market is indicating an expectation for a slowdown. If we move forward 2 pages to slide 14, what we're trying to point out here with this crashing wave coming forward is that while the Fed has moved very aggressively, the fact that they've moved so quickly to raise rates means that we probably haven't felt the extent of the economic contraction that they're going to result in. So the raising of rates there's 2 main levers that the Fed can pull. Obviously, it's how they raise the rates, and then also how long they keep them raised. So these high, 4 to 5% interest rates have only been in effect for a couple of quarters at this point. There's plenty of businesses that haven't had to raise debt or refinance. So that, if you raised a good capital cushion in the last few years, while rates were low, you might still be able to sit on that and avoid going out to the market to raise more debt. But as long as the Fed continues to keep these rates at these higher levels, they don't have to necessarily raise rates any further to have continued contracting effect on the economy. The longer they leave the rates at these levels, the impact will continue to build and be felt in more and more areas. But as we move on to the next page, we can see that the U.S. stock market, at least, really isn't showing any fear, despite like I said, the pretty clear signal in the bond market that a slowdown is expected. We can see stocks have largely recovered the losses from last year. Meanwhile, the VIX is back down to multi-year lows. So lower volatility, continued high returns. Would like to point out that the returns have been relatively concentrated, which is not a sign of a very healthy market when the gains are concentrated within really a handful of higher growth expectation technology related stocks. So that's an area of concern, despite strong overall market returns. That weak market breadth is an area of concern to keep an eye on. So having talked a bit about the economic outlook here, I'm going to skip forward some of the usual slides and go to page 22. Just make a few comments on some of the different markets that we track here before handing it over to Steve to talk about the portfolio. Want to point out here in the top right, you can see the top line there is information technology, up over 40% through the first 2 quarters. There's only a few of those light blue bars that are really showing where all the gains are concentrated, to carry on with my previous point about the poor market breadth. Not only is it just a few sectors that are really driving the gains, it's literally just a few very large cap names. You can see in the table in the top left, large growth up 28.7% year to date, large value still up 10%, but relatively being left in the dust. And that's shown in the bottom right chart, where we had value actually outperform growth through three of the 4 quarters last year, but now those 2 big bars on the far right of the chart show very elevated levels of large cap growth outperformance versus value. Again, that's tied to what I was saying before about the poor breadth in the market. Some really mega cap names are driving returns this year, and NVIDIA up over 200%. The old FANG names up 10, 20, 30% in some cases. The market's really rewarding companies they think are going to be able to continue to drive growth, and the gains are really concentrated in some of those mega cap tech names. Moving to the next page, the non-US equity market. You can see here that developed markets continue to outperform emerging. So for the quarter, the EFI index up 3.2, emerging up 1%. For the year to date, the last 2 quarters, that's 12 to 5%. And then over the trailing 1 year, emerging markets really been left behind, as developed markets are up 19% and emerging's up only 2. In the bottom right, you can see China is negative for the quarter and year to date. That is a very large portion of the EM index. So as China goes, the index is going to have a very difficult time shaking off the effects of negative returns from China, which is what we've seen so far this year. And lastly, on page 24, just want to spend a minute on fixed income and point out the yield curve in the bottom right. From 331 to 630, we see that light blue curve shifting up to the dark blue. So pretty much parallel shift across the curve. We remain inverted, as I was mentioning in those earlier slides. The short end of the curve is significantly higher than the 10+ year portion of the curve. And with that shift higher in rates during the quarter, you can see in the quarter column in the table up above, generally negative returns for the quarter as those rates pushed higher. High yield and leverage loans being the exception there near the bottom producing positive 2% and 3% returns roughly. So if there's no questions, I'll turn it over to Steve to talk about the how the portfolio performed in this market backdrop.
Don't run off too quick, David. I've got a couple of questions on what your all's thoughts are. I noticed you didn't touch on, I think it was page 7, your capital market assumptions. You know, they seem to be somewhat changed from the last time we met, number one. And then my other question is, I noticed on just the last few pages that your consumer and your business activity numbers. Looks like consumers just kind of laying there still flat, but it looked like business activity, you know, industrial activity had picked up. What is your all's thoughts on those two things and how the Fed's going to view that in light of the recent UAW vote and, you know, the amount of money that's going to get pulled out of the consumer spending train with the start of student loan payments?
Yeah, we'll start with the assumptions since I see they're already up on the screen here. We are in the process of reviewing the asset allocation as part of a full asset liability study. In general, what those studies we're doing for clients, including yourselves, is pointing us to is compared to the regime of a few years ago when fixed income offered nearly nothing. Fixed income is once again a relatively attractive proposition. So these asset allocation studies that we've been working on tend to see clients shifting back into fixed income somewhat now that it is offering a better return, and stock markets are relatively highly valued given the quick recovery we've had in the last 3 quarters. So like I said, we're working through that process now. We want to balance our forward-looking assumptions with the desire not to whipsaw the portfolio every few years and move too drastically between asset classes, and try to be thoughtful and gradual as to how we move those targets. But would expect the general theme to be you can get a bit of efficiency out of the portfolio by taking a little bit of growth off the table. So as far as our outlook on the consumer, there's definitely a cooling or maybe almost a nearly complete exhaustion of the buildup of savings that we saw. The combination of COVID, meaning you couldn't go out and spend your money except on those Amazon packages piling up at the door, and government stimulus going into people's pockets. There's several different indicators that show that the consumer is starting to feel a bit of a pinch again, whether it's loan delinquencies, credit card balances, or the household debt service level. With higher interest rates now, the level of debt is generally, I think, getting back to roughly where we were pre-COVID. So we're getting close to those, that increase in savings and that government stimulus effect having roughly worked its way out. But at the same time, we've seen consumer sentiment, which is a bit more forward-looking, bounce off the lows from earlier this year and start to improve a bit, although it's still well below the long-term average. So the consumer, on page 18, we can see that, like I mentioned at the top, we can see the consumers getting slightly more optimistic. I think a big part of that is they're seeing inflation cool, so that gives them a bit more reason to be optimistic that their paycheck won't be more and more eaten up by the necessities and leave nothing for their wants. We see that personal consumption expenditures in the bottom left, that is relatively muted but remains positive, so consumers are still going out there and spending. It'll remains to be seen how big a headwind the resumption of student loan payments is. It's definitely going to have an impact on discretionary spending, but to the extent that different laws are passed that might allow those payments to be spread out for lower income earners who we'd expect to have the biggest negative impact if they had to resume payments in full. If they're able to keep those payments relative to their income at a relatively manageable level, it might not have a huge negative impact. That's one where we don't necessarily have a view or a projection, because it's I think it's going to be relatively difficult for anyone to know exactly how that's going to play out until we start to see the data roll in. But the consumer is back roughly to where they were in late 2019, although in terms of the debt levels and the relative to their savings rates, but that debt is more expensive now. So that is definitely expected to be a headwind as we go forward. And like I said before, that looking at our assumptions and these potential headwinds to the economy, growth assets are a bit less attractive, and safety and diversifying is a bit more attractive now.
I'll
I-
just
I would-
add just a, oh, I'm
Sorry,
sorry.
go ahead, David.
Go ahead.
I was gonna say,
I was
I'll
just gonna add-
to-
Oh.
I'll add to
Go ahead,
Craig's
Steve.
comment, sorry.
You go, Steve, go.
Yeah, the consumer picture is complicated, as we're all well aware. I think three of the big influences Craig talked about: jobs, which are still strong. I think we're seeing cooling, obviously, today's print and ADP, and in the wages numbers, which is exactly what the Fed's looking for. So, and then we're seeing, cooling of inflation to some extent. We're still dealing with sticky inflation in a number of areas, and then sentiment is going to be driven too by stock market, right? I mean, and the strength of equities tends to lead right into, positive consumer sentiment. We revised down second quarter GDP today, but the interesting part of it to me was household spending was revised up. I think there's been a shift to some extent in that spending, and that's more services oriented. Travel and leisure is going gangbusters a lot of places, and that's some of that is pent up, built up from the delays caused by COVID. But overall, I think, as Craig was saying, that the balance sheet of the consumer is still pretty strong. That I think what that all leads to is a Fed that's, while we've paused, it's hard to guess whether or not. I think there's real data dependency here, whether or not we hike once more, twice more. I don't necessarily think 25 or 50 is material, but it does mean we're near peak rates. And the big question becomes, obviously, the focus shifts then to when does the Fed pivot? When do we start cutting rates? Market consensus has goes back and forth kind of almost on a weekly basis. If we look at the pricing in futures markets, into whether we've pushed out further or pulled toward us when they're going to start cutting rates. And I think our view as a staff, and probably aligns well with Wilshire's, is that we're probably going to be higher for longer. So we may not rise much from here. There may not be any additional tightening, but I think the Fed is pretty committed. If we look at the speeches that came out recently, they're very committed to maintaining rates at elevated levels, expecting some degree of deterioration in the economy as a result. I think they need to see further softness in the jobs market and the wages specifically, before they would even really consider embarking on that path. So I think we're going to be here for a while. I think we're going to be at elevated rates. And to Craig's point, we always talk about, in cycles, the lagging impact of raising rates on economic activity. And I think it's even more pronounced in this cycle, given the speed at which those rates were raised, as Craig rightly pointed out. A number of, if we look on the corporate side, outside of the floating rate debt, there's a large swath of firms that haven't had to deal with these elevated rates yet. They either haven't had to issue significantly, or they haven't had to refi. So they're still relying on debt that was issued at historically low levels. So it's going to take some time for that to play through. And I think all that means is we're likely to see a Fed that's, again, whether they do another quarter in November or not is to be seen. But they're likely near the peak. But the expectation, at least internally, is that they're going to keep those rates elevated for an extended period of time. David, sorry, I didn't mean to cut you off.
No, that's good. Yeah, I would just add one, because it's all been well said here. I think to the consumer point of this, like many of the other things you just talked about, Steve and Craig talked about, there's a lag that is happening. And even for the consumer, we think there's probably a bit of a lag in terms of consumer spending and all these things we just talked about, where the debt levels are building up, the savings levels are going back down, and rates are high. Eventually, the consumer, they've been still driving a 2.1% GDP that drives 70% of that. So that is, there's going to be a lag to that cooling too, most likely, but it all ties right into the story that rates are probably here to stay for a little bit. And the Fed is expecting all of this to, do the unwinding they want it to do. So it's just a matter of watching it happen over time.
Yeah, that 2.1%. I mean, if we look at, I think you guys probably are on top of this more than I am, but the GDP Now tracker, I think is still, high fives, 5.9, 5.7, the Atlanta Fed GDP tracker. So for the third quarter, the early estimates of the third quarter. So we're not seeing, those tightening financial conditions really flow through to the real economy yet.
So on a risk adjusted basis, where are you seeing our best opportunities as far as deploying any allocations or cash or whatever? Is that strictly on the credit side of the equation, or do you see some opportunities out there anywhere on the equity side?
I think, I'll start and I'll let Wilshire add their perspective as well. I think from our perspective internally on a risk adjusted basis, some of the higher up the cap structure debt is really, really attractive, both on a historical and on a current risk adjusted basis. And that's any of those, investments that have a large yield component to them, given the rise in rates, just makes them naturally more attractive. And obviously on a comparison basis, growth related assets, as Craig was mentioning, the shines come off a little bit. And that's broadly, I love the point he was making on the breadth of the market. We get overwhelmed with, seeing the headline numbers especially on US public equities. And, looking at that, I'm going to look more for the fiscal year. So the last year, 12 months as of 6/30, and the narrow breadth there is really it's raising a lot of red flags. I think that are not necessarily appreciated more broadly because the headline numbers look so good. I think in that 12-month period, the top 10 largest stocks in the U.S. large cap growth space accounted for about 50%. I think we're right around there, about 50% of the overall market's return. That's incredibly narrow breadth for public equities, and that really, that undertone of that is pretty startling to me. I mean, I think that's shows signs there are a lot of pockets of weakness. We see, as Craig was, some of the graphs they were showing, it's the concentration has been in some very narrow sectors. So the broader sectors have not participated nearly as much in the appreciation. So our view is that, I think we're not looking to allocate week to week, day to day. But, if we look currently point in time and our outlook over the next 2 to 5 years, growth, any investment that is more driven by growth, I think is going to struggle on a relative basis. So I think Joe has done a really good job in the public equity portfolios. We'll get into in a little bit in positioning both from a cap perspective as well as domicile perspective. So maybe there's a shift there that we may take an exposure that has a little bit more of an international tilt than a U.S. tilt at points in time. I think that's where you'll see us around the edges managing, as opposed to an outright getting exceptionally short public equities. But I think from if I had to be put on the spot and say where's the best opportunity to lie right now, it's probably in that that specialty credit bucket that has on a risk adjusted basis is offering very compelling returns on senior secured level, so well up the capital structure.
What?
So
I don't know if Craig or David want to add to that as well, but that.
Steve,
thank you.
where are you as far as your duration? Are you looking to get further out on the duration
So
scale?
I have that comment, but I'll go ahead and give it to you. That's part of the commentary I was going to have. Is we just finished up our second round. So as you're well aware, we had a short, especially in the core, right? That's where duration resides primarily for us. In that core portfolio, we had been short duration relative to benchmark. Really since the COVID days, we went short in anticipation of one. Core wasn't providing that ballast that it typically does in a ZIRP world. So we didn't think the risk return profile was very attractive. So we shortened the duration of the overall portfolio in anticipation of rising rates and the fact that it wasn't offering much. We were fortunate in that the timing was pretty good. So we rode that short as the rapid rise in rates and the magnitude of that rise in rate. And so we've recently completed the second round of shifting that duration profile of the core portfolio. So we're out of what was that short corporate product, that 1 to 3 year corporate product, into more of a full core type of allocation. So that's, I think we're there now, and that is not, again, it's not necessarily anticipating a dramatic pivot by the Fed and a cut in rates, but we think that the risk reward and the yield we're able to achieve there. Timing wasn't, it was a little less than optimal. We did it in 2 large tranches. We missed kind of the second leg of the rise here in the third quarter, but it wasn't about calling a top or a bottom there. It was really about, we thought that rates had moved to where we thought was a reasonable entry point. I think it's positioned well. I think we're comfortable with the position for what we see as the risks to the economies and how the rates how the curve is going to play out. As Craig mentioned, that inverted curve makes managing a core portfolio a little more difficult, especially when we look at our liquidity program is achieving anywhere from 5.25% to 5.5% on a daily basis. So that opportunity cost is not necessarily significant. We'll get into that with allocation in a little bit, but we have extended the duration of the portfolio to be more core-like for the overall duration profile.
That's the gist of all my questions at this point. Anyway, I see our chairman is back online. Dr. Hackford, if you want to take back over, we did not pass the minutes because we did not have a quorum. You may want to back up and do that while we do have a quorum. Dr. Hackford, you're on mute. I'll tell you what, Steve, why don't we go ahead and let you continue until Dr. Hackford gets his sound.
Okay. Sheriff, if you could turn to page 35, please. And I'll try to keep comments fairly brief here as we're dealing with information that's a couple of months old already, but I really want to highlight the quarter and the fiscal year as it was our fiscal year end. Wilshire has always did a great job kind of covering the market overview. Fiscal year 2023 presented was a very challenging investment landscape. Significant dispersion, as they outlined, across major asset classes as markets struggled with the headwinds of uncertainty from rising rates, slowing economic growth, and geopolitical tensions. And that's pretty unique. I think we're that was a challenging part of the year, is that the degree of dispersion, not only within an asset class, as they highlighted within public equities, that broad category, there was significant dispersion, but then across all asset classes that we look at. For that fiscal year, public equities did great. Several asset classes, including fixed income, real estate, private equity, and commodities, all produced negative returns for the fiscal year. As the narrative shifted from transitory to resilient that we've talked about, the portfolios produced strong absolute performance during the final quarter of the fiscal year, although they did trail the benchmarks in that strong risk-on environment for the last quarter. In hindsight, kind of the discussion we've been having is, that we probably could have positioned the portfolios for the first 6 months of the calendar year, a little less conservatively, but we think it's prudent to maintain our discipline strategy and take opportunities to de-risk and rebalance the portfolios, as we talked about, especially in public equities, in anticipation of a pickup in cross-asset volatilities as those tightening financial conditions really start to bite. So we did over the quarter take an opportunity as public equities continued to appreciate. We rebalanced back towards target several times, and I think we feel like we're in a good position to take advantage of opportunities that may be presented in the market over the coming months. We don't anticipate a significant dislocation in any markets, but we have lots of liquidity. We're positioned well to take advantage of it. And we're continuing to deploy capital as we see opportunities. The CERS and CERS hazardous pension portfolios returned 3.3 and 3.31% respectively, while the CERS and CERS hazardous insurance portfolios returned 3.24 and 3.25 compared to the benchmark, which returned 4.06 for the quarter. The portfolios underperformed their benchmark during the quarter due to similar drivers of attribution. While the portfolios benefited from their underweight to real return asset class, the relative underperformance in public equity and private equity portfolios weighed on performance. So it was a strong absolute quarter. On a relative, we did underperform. For the fiscal year, all of the portfolios exceeded their assumed rates of return and significantly outperformed the benchmark. The CERS pension portfolio gained 10.24%. CRS hazard pension and CRS insurance portfolios both returned 10.33%, while the CRS hazardous insurance portfolio returned 10.11%. For the fiscal year, the benchmark produced a return of 9.54%. So as Dave always likes to do in dollar terms, that outperformance for the fiscal year equates to approximately $87 million in the pension composite level and $36 million of outperformance at the insurance composite level. I think what our takeaway as staff for the fiscal year is we're very encouraged by the durability of the portfolios. If we look at that entire 12-month period, there were very strong trending down markets and this very strong trending up markets. And the fact that the portfolios were able to outperform throughout that, I think really speaks to the composition, the asset allocation, and the manager selection that's been done in the portfolio. So we're very encouraged by that. Again, as we move forward, regardless of market direction, we have a high level of conviction that we should be able to outperform the benchmark. An update: July valuations are still being finalized, but just preliminary performance estimates are tracking around up 2% for the month of July. We still have a little bit of time left in August, so I won't speak to that yet, but markets have continued to be resilient. We'll see as data continues to come in. As I mentioned, we saw a revision down in GDP growth today. Third quarter GDP growth is still estimated to be significantly above 5%. We have a few weeks before those final numbers will start, or the first estimates of the final numbers will start coming in. But we expect third quarter to be a strong number. I think we expect the fourth quarter volatility to pick up. We're going to start to see whether or not the Fed is permanently on hold, or maybe they take one additional hike before the end of the year. We'll start to see some of the effects of those tighter financial conditions play through, both from corporate profits as well as economic growth. So we anticipate volatility. I think that's the one thing we can count on. As far as the recession indicators, personally, I think we're probably still primed to enter a bit of a recession. I think it's moderated from our views earlier this year. I think we anticipate it not to be very long and not very deep. But I think given the amount of tightening that's gone on in the financial markets, that it's likely to see at least a period of what is going to be characterized as a recession. Gary, if we can move to
Steve?
Yes.
Any questions? Can you hear me now? Yeah.
We can hear you now. Yes.
Yes.
Okay. All right, good. Any questions of Steve? We could use a report like that every year. Okay. Just keep it
All
up.
right. We'll keep it up. We'll
Right.
certainly try.
All right.
Sherry, if we could go to page 41,
I
please.
apologize. Please continue.
Okay.
What page again, Steve?
I don't have an agenda, so okay. I'm kind of flying blind. I don't have an agenda because on my phone. So please proceed. Yeah.
41, please, Sherry. Thank you. Manager outperformance and staff's positioning within asset allocations. And those are primarily that short duration and core and Joe's positioning both at a cap level and international versus US in the public equity portfolios were the most significant drivers of outperformance for the year. Public equity and core fixed income portfolios combined to produce between 75 and 85 basis points of outperformance for the year. To Dr. Hackbart's point, we'll try to keep that up this year. That's a pretty high bar we set there. But again, across asset classes, I think we were really encouraged by the performance of individual mandates. The tailwinds for the year were, which partially offset that strong performance, was underperformance in the specialty credit portfolio. And that really, while individual managers did well versus their mandates, if we look at that benchmark versus how we position that overall specialty credit high yield portfolio, we have a lot more structured credits. Some of that is mortgage related credit relative to the benchmark, which is pure public high yield bonds and loans, which didn't, in our allocations didn't perform as well as some of those public markets. Those public markets performed very strong. There's also, for the specialty credit on the private side, there's a lag in performance, a quarterly lag in performance relative to public markets. So we do anticipate a little bit of catch up. For the fiscal year, and this will be something we'll talk about here in a minute as well, that the overall asset allocation was a very muted driver of performance, ranging from neutral to slightly negative as we worked in moving portfolios towards their allocation targets. The portfolios benefited from their underweight to real return and to a lesser extent real estate, which was partially offset by the corresponding overweight in specialty credit, which we have been using as the proxy asset class while we work to achieve those targets. Specifically for the asset allocations, which were outside of the IPS ranges, which we've talked about for several meetings, I did want to say that the impact on performance was modestly positive for the fiscal year, contributing between 20 and 22 basis points of relative outperformance compared to the benchmark. So those two asset classes, which are really the real return or real asset and specialty credit, which we're utilizing as the proxy, the combination of that underweight and overweight was actually positive on an attribution basis to performance relative to the benchmark. Page 45, please, Sherry. Even though we're almost in September, performance data for the peer universe continues to be updated. Current data shows the average performance for the year ending June 30th will be in the range of about 6.5% to 8%. Much like the investment markets, there was a high level of dispersion among plans, and that was primarily the biggest driver of that, and it was based on size, and that tended to be smaller plans really outperformed larger plans, as we saw a couple of the large California-based plans reported performance for the fiscal year with a six handle, anywhere with 6.5 to 6.8. And that was really driven by allocations to alts, so to alternative asset classes, which tended to underperform for the year. So the smaller plans, which usually have a higher allocation to public markets, especially to public equity, outperformed for the year. And the dispersion between those was a higher degree than certainly it has been in recent years. With we saw a range between large plans and small plans up to well over 600 basis points, which is pretty unique. I mean, that's and that, again, driven largely by the difference in allocation and specifically in the alternatives. Despite the lower risk targets and allocations of the plans, based on the Wilshire universe, all of the portfolios achieved top quartile or were just outside of top quartile performance for the 1 year period, with consistent performance relative to peers over longer periods as well. This level of relative performance has been achieved with a much lower risk profile, as indicated by that middle graph and chart. And this level of performance and risk combined to produce top decile Sharpe ratios over the 1, 3, and 5-year periods, indicating that the plans are consistently producing very strong risk-adjusted performance. Again, that's where we tend to focus, is what we're, how much return are we getting per unit of risk? What's our risk-adjusted performance? That allocation targets that we achieve, that we receive from the board and from the investment committee. Those are kind of our guidelines with which we operate. Obviously, we're working towards those targets that were revised for the private asset classes, but that's kind of the parameters with which we have to operate. So the combination of that risk profile that's given to us, and then the performance we're able to achieve by managing our allocations, selecting managers, kind of combines to do that risk-adjusted performance. And I think that's really where we focus most. And I think that's where it shows both the work of the team as well as the work of the investment committee and the board. Page 53. Thank you. As of the end of the fiscal year, the portfolios were underweight real return with a smaller underweight to real estate and private equity. We have maintained corresponding overweights in the specialty credit high yield allocation, as we believe it serves as the best proxy for these asset classes, given the similar risk and return profile. As I think David and Craig both mentioned, we're going through a full asset liability study, which will include suggested changes to the current asset allocation targets and ranges. So we anticipate probably moving a number of different asset classes as we look to increase efficiency of the portfolios, as well as to increase the probability of achieving those expected rates of return. Across the system, so this is CK, state police, insurance, and pension. We currently have commitments of approximately $400 million to real estate and $725 million to real return mandates. So that's capital that we've committed that's not been called yet. We anticipate that they will be called and deployed by the managers over the coming months, and should in and of itself move the portfolios closer to the existing targets. In real return, the mandates that were approved earlier this year have been active and are deploying capital. KPPA has met 2 capital calls totaling about 20% of the commitment to one of the managers, and we anticipate a significant and sizable large co-invest opportunity in the coming months from that manager. Another manager is close to finalizing deals that would see our entire commitment called likely in the next 4 to 8 weeks. So we're excited that they're deploying capital. We're finding great uses for investing that capital at very attractive yields and expected returns. So we're excited to get that capital deployed. We continue to work and do some due diligence on a number of other mandates, both new mandates and additional allocations to existing mandates in the real asset space. And again, that's another one where we find some unique opportunities. We're not plunging a bunch of money into generic commodities. We're actually looking for things that are complementary to the risk and the return profile of the entirety of the portfolio. And those take a little bit more time, but we're excited about the opportunities that we're looking at. As I mentioned, we fully rebalanced the core portfolio. In addition to extending the duration, it also brought about 20%, a little bit less than 20% of that core portfolio in-house to be managed. So we're excited about that opportunity as well. As I mentioned earlier, we continue to be cautious deploying capital, especially in markets where we feel valuations are a bit stretched. We think those stretched markets could potentially see more significant adjustments as tightening financial conditions continue to bite. And we also are managing the existing allocations with the expectations, as I mentioned, that we could see revisions in the revised IPS based on the efficient portfolio modeling that Wilshire is doing with staff. I mentioned that our liquidity program that Brian manages is currently achieving anywhere from 5.25% to 5.5% yield on a daily, day in, day out basis. So the opportunity cost is a lot less than it was 18, 24 months ago. I think being able to achieve those yields. They won't last forever, as we know, but currently, a 5.5% yield on a liquidity program is pretty attractive. So we're comfortable maintaining potentially higher levels of liquidity than we would otherwise. Page 66. Very brief update on the investment budget. For the fiscal year 2023, we came in under budget by 2.4 million, spending a total of just under 6.2 million. As I've highlighted here, the investment budget for fiscal 2024 was recently approved and is included. The biggest changes, as you'll note, were the budget for legal expenses. Blame it completely on Vicky. And they were increased based on recommendations from legal. And that really is the result of anticipated movement and activity related to ongoing litigation to a number of the different cases where we expect movement in fiscal 24. We did reduce the budget for custodial services from what was budgeted in 23. And that was based on a determination that we made as staff that we were not going to add additional services that were offered by the custodian that we were looking at one time. Obviously, it's a bit of an a la carte menu with some of the BNY services. We think we've got some alternatives there. So we reduced the budget accordingly. The net result was an increase in the budget of 1.7 million for the next fiscal year. I'll pause there if there's any questions on the budget, just in case. That's always a good one.
Steve, I think I've asked this question before, but under your consulting services,
Yes.
Allborn and Mercer Insight.
Yes. So Allborn is both of those are access essentially to a research databases that we use. The Mercer one is part of the Solovis environment, and Allborn is for private markets.
And those aren't services that we're getting out of Wilshire?
So Wilshire's contract, we and David or Craig may want to speak to this. A decision was made at one point in time that that's an additional service that Wilshire provides, is the private markets research. And our contract was amended to exclude that service.
Okay.
That's part of a project that's ongoing, is the review. Again, part of certainly on the Mercer and Allborn decisions were made under the prior administration. I think that's on our agenda for fiscal 24, is to do a look of a review of kind of all of the services, not just consulting services, but all of the services that we utilize as staff. We carried forward the existing budget, anticipating that any changes we would make would unlikely, certainly to be in the first half of the fiscal year. But that's going to be an ongoing project, is it's working with Wilshire to see what services we're utilizing versus not utilizing, what the cost benefit to that, what else may be available from them, as well as other third-party providers.
Okay.
Yeah, Steve, I'll just add to that. That's exactly right. We, a couple of years ago, you had scaled down our role in alternatives, but Steve and we have talked back and forth numerous times about just revisiting all of this and creating the most efficient solution that we can. So those are ongoing discussions.
Yeah, I would expect to see some progress on that in fiscal 24. Again, it's one of the higher priority items that we have.
Okay, thank you.
Sure. Page 74, please, Sherry. Compliance report. We continue to streamline the compliance report. It should look pretty similar to the last one. We are making progress on adding some additional reporting to it that hopefully will be available in the next IC meeting. And that's really to focus on, where we see our levels of compliance, which is really at the IPS, the investment guideline, and the statute level. It is nice to report, as of the end of the fiscal year, all of the portfolios are in compliance. So all of everything is green. And as we continue to roll out new functionality on the compliance front and new ways to look, You know, our goal is transparency as well as providing the information that the IC and the board needs really to fulfill their functions. So, you know, as people have a look or have questions about this, please feel free to reach out to me or other staff, what things you would like to see in the compliance report. I think we've done a big revamp on it. We streamlined it and taken out a lot of things that weren't necessarily compliance related, that have kind of been historical artifacts of this reporting. So hopefully everyone finds it more useful than it was in the past. I was going to provide a very brief update on the investment office. The big one that we've talked about already is, you know, we're engaged with Wilshire on the full asset liability and asset allocation work. I hope to bring that in front of the committees, you know, maybe hopefully within the next quarter for sure. Make some recommendation on changes, you know, look to take advantage of some of the opportunities we see in the market and really just create, you know, goal in mind is to maintain our liquidity. We like the liquidity profile of the portfolio. We know that's very important. So you won't see us put, you know, 70% in private markets, regardless of kind of how efficient that may or may not be. You know, we want to have the most efficient portfolio possible. So something that, you know, increases the probability over time of achieving those assumed rates of returns that we have. Also, we want to take advantage of, you know, the changes in the markets. The last time that asset allocation was done, capital market assumptions were materially different than they are now. So just a little bit of work, we can increase, you know, lower the risk profile. You know, I think that's achievable and still maintaining or increasing slightly the expected rate of return of the portfolio over time. So with those goals in mind, you know, that's what we've been working towards, and I expect we're probably close to entering the final stages of the modeling work that will be presented to the investment committee. As of 6:30, we are utilizing the Solovis system, as I mentioned, as a platform to perform independent performance calculations of our custodial. So BNY being the books and records is our official performance, but Solovis, we're utilizing that as for the first time as our ability to really do an independent validation of the performance that BNY is calculating. Our goal there really is not to, you know, to do you know, it's more to catch issues that BNY might have, and we've come across a couple of those, whether it's a timing issue, a pricing issue, or a coding issue on their end. You know, and while we'll rely on BNY for the official, it's nice to have kind of that independent evaluation that says, yeah, this is a reasonable return based on what our expectations were. What has been a very long process, and kudos to Joe here. We're happy to report as of 6:30, we have finalized all amendments so that we are voting the proxies for all eligible securities in accordance with the CERS proxy voting policy. It took a lot of work on Joe's part, but we got there, and you know, we will also be in compliance with the statutory reporting requirements as of the end of the next quarter. So that'll be our first proxy report posted to the website in accordance with the new statute. And we still have some work. Joe's still got some work to do there, but I have a high level of confidence that he'll be able to get that done. So you know, I think that was a big feather in his cap to get all of our managers over the line. It wasn't easy, and so give the IC and the board confidence that you know, their proxy voting policy is being adhered to for all of the eligible securities in the portfolio. The KPPA executive team is working with legislators on language which would allow us to secure office space for the Office of Investments. Dave wanted me to point that out, that he's hard at work negotiating and twisting arms to get us to have some language that would allow us to lease some space in Louisville. I think that's great, especially as we're continuing to look to add staff. You know, we definitely want it to be the right person, the right skill sets as a complement to the existing team. You know, I do want to say that there are no concerns that anything is falling through the gaps with the existing team. I think it would just be, you know, we would like to add some qualified staff, a little bit of relief for everyone, but also maybe to dig deeper on some project-based work. So we look forward to that, and I think having an office space, is helpful in recruiting and retaining staff. So I look forward to that. Hopefully we can get that over the line in the next session, and then look for an office space. So that's all I had. If there's any questions, happy to answer them.
Well, thank you, Steve. I think I might be back on board. Unfortunately, I apologize sincerely because the Spectrum man was supposed to be here this morning, but he showed up about 10 minutes to 2, and
Perfect
I was
timing.
at his mercy. And so I apologize and thank you for continuing in the absence. I guess one question I have, Steve, do you think it'd be worthwhile once you have the asset allocation study completed, have a special meeting for that to go through it in some detail versus trying to do it at a regular meeting?
I would, yes, I think it would warrant a special meeting to go over it, obviously get it to everyone well in advance ahead of time, and open it up for discussion and questions, and kind of let us lay out the case for why we think it's the appropriate asset allocation. I think that would make a lot of sense.
And again, what would be your time goal on that as terms of availability?
Ideally, some of this is, it's a little iterative in the back and forth with Wilshire and
Right, certainly. Mhm.
But I would expect, and Craig can scold me if I'm wrong here, but I would like to have it wrapped up, from our perspective and ready to present certainly in the next 4 to 6 weeks.
Okay, good. Thank you. All right. I believe that completes our program for today, unless I'm wrong. And I do recall we do have to have a vote for the acceptance of the minutes. So would someone please move the acceptance of the minutes as reported?
So moved.
Is there a second, please?
I'll second that.
Thank you. We have a motion and a second to approve the minutes as presented. All those in favor, please signify by saying aye.
Aye.
The motion is passed. Thank you so much. And again, I just got a quick glance at the agenda. I believe we are finished, unless there's any items that anyone would like to comment regarding the presentations or further questions that you would like to have either Steve or Wilshire respond to over the next few days. In the absence of that, I would accept a motion to conclude our meeting.
So moved.
A second, please.
Second.
Thank you for the motion and a second. All those in favor of adjourning our meeting, please indicate it by saying aye.
Aye.
Thanks so
Motion
much for all the
carries.
information.
Thank you, everyone.
Thank
Yeah,
you.
thanks for the enlightening presentation and so forth, and the really